A client of mine recently came to me. They said, "Hey, David, I'm leaving my job at the end of the month. What should I do with my 401k?" It's a great question. It's one that we get multiple times a year. What's interesting is that if you look statistically over the last 50 years, the average length of stay at an employer is under 5 years. So the reality is at some point in time, everyone is going to face a situation just like this. So the question then becomes, what do you do with your old 401k? Do you leave it at your current employer? Do you roll it into your new employer's plan? Do you roll it into an IRA? Or even something else? My name is David Heller. I've been a financial advisor for the last 16 years, helping clients navigate important financial decisions just like this. In today's video, we're going to walk you through what we believe to be as the four main options that you have when facing this type of situation. And as always, we'll weave in a lot of the common questions that we hear, not only from current clients, but also from prospective clients, as far as a lot of the things that other YouTube videos don't really talk about, kind of the frontline conversations, if you will. So with all of that being said, let's get into it. For this video, I'm going to show a decision tree versus a general slide deck, just to show something a little bit different. I'm going to try it out. We'll see if it works versus just going through a basic pros and cons in a slide deck. So as I mentioned before, there's really four main options. The first option is simple. It's to leave it at your old. Now, this in turn happens to be really the easiest because you don't have to do anything. I've divided this into both good and bad because, again, everything is situational. So I'm just laying out a couple of thoughts, but ultimately you make the decision as far as what's best for you. So on the good side, I haven't really seen a situation where you're going to be forced to move your 401k should you leave your old employer. In most situations, you can leave it there as long as you want. So I labeled this box as flexibility just because you can always decide to roll it over at a later date because let's face it, when you go through a job change, there's a lot of things going on. So you just might not have time or the brain capacity to figure out or think about what to do with your old 401k. The good part of that is the fact that the money is going to actually stay invested. And so when the money stays invested, you're still in the market. And as you know from a lot of the other videos that we've gone over, is you want to stay invested in the market regardless if it's going up or down. You don't want to get into a situation of trying to time things. So because you're not forced to move the 401k, this actually winds up being a good thing because, again, the money stays invested and you're going to get both the ups and downs of the market. The other two things that I see here on the good side is because a 401k plan is governed by ERISA, which sets the rules and regulations for 401k plans, there is something in there that has creditor protection. So should you ever face a situation where maybe you had a lawsuit or you had to file bankruptcy, that money is actually protected. Then there's something called the age 55 rule, which if you leave your employer in or after you turn 55, you can access the 401k without paying the early 10% withdrawal penalty. That's not necessarily the case if you roll it into an IRA where that age is now 59 and a half. On the not so good side, as I've stated in other videos as well, you know that you have limited investment options in your 401k plan. They'll give you a menu of anywhere from 10 to 20 different choices. There'll be a handful of target date funds as well as stock and bond funds, which you can then choose from within different asset classes, whether it's like large cap or international. And you can decide what that mix is based off of your situation, what you're trying to achieve. I would say that when dealing with clients, I rarely see this as a reason that someone's given to me as to why they want to keep the 401k at their old employer. Again, generally, these are run-of-the-mill type funds by a specific fund. I did have one situation where a current client, he's at a financial services firm. They run different funds that are really limited to institutional investors, so not retail. And so they give him access to some of those funds through his 401k plan. And then returns were pretty impressive. And it's a strategy that you can't normally get in the retail marketplace. So in that situation, it was like, yeah, why not? More importantly, keeping your 401k at your old employer, while short term it might be easy. In my opinion, I almost consider it to be the lazy way to do things, because what ultimately happens over time is, and if you remember in the beginning of my video, most people stay at a current employer for under 5 years. That's the average. So you end up having more financial clutter. And that is something that I commonly hear, is that they end up accumulating 3, 4, 5 different 401k plans So every job change means another account, another login, another statement. And then when you wake up one day and you say, you know what, I've got accounts all over the place, I want to consolidate this, it becomes a real hassle. Now I see this more often than not. I had this again 3 months ago with someone who came to me and they said, you know what, I want to consolidate everything. It's all over the place. It's very difficult to manage. The reality is when you try to roll out those 401ks, you have to call each provider and roll them out. And that process can take anywhere from 20 to 25 minutes on average. So think about that. If you've got 4 different 401k plans, you're talking about 2 hours that you're going to be on the phone dealing with customer service and trying to coordinate where all of the funds are going to go. So what's going to happen is when they roll out that 401k plan, it usually involves tracking a check that might come to you. It might go to the custodian, depending on where you're rolling it to. And that process can take 2 to 4 weeks. So from a housekeeping perspective, it winds up just being a complete headache and almost a waste of time. But again, you'll end up saying on the front end, well, I'll just deal with it later and kick it down the road. But just know you're going to pay the price later on. RMDs, or required minimum distributions, those can get messy later on. Because of the fact that you've accumulated different accounts and you're going to have to start taking withdrawals at some point in time, instead of having maybe one account, whether it's a rollover IRA or maybe your current employer that you're utilizing, all the calculations can be made off of that one particular account. You're now going to have multiple accounts that you're going to have to go to and figure out what the right percentage is from a RMD perspective to be pulling out. The last thing I'll mention here is that your old employer controls that plan. You can change providers at any point in time. They can adjust the investment menu or even change fees possibly. So that's really, you lose all control in this perspective. I would say, so that's what I would say. And the other thing I would say, because I see this one frequently, is when people have accounts that have been sitting around for a while, they typically forget about them. I had this situation earlier this year where someone had an old 401k. They hadn't looked at it in probably 4 years. We were looking at bringing over all of their accounts. And when I got the 401k statement and looked at it, I realized that half of it was sitting in cash, and it was a sizable amount. It was about $200,000. And so I asked the client, why is this sitting in cash? And they said to me, I don't know. That has happened multiple times throughout my career. And that generally is not a good thing. So in summary, yes, leaving the 401k at your old employer, it's the easy thing to do. Short term, it's probably not the worst thing in the world. But long term, from what I've experienced, it just winds up being a big headache later on. And it just creates more inefficiencies than anything else. The second option is to roll the old 401k into your new employer's plan. The biggest advantage here is consolidation. As maybe you can tell, I don't like financial clutter. So having all your retirement money in one place makes it so much easier to manage and track. Again, instead of juggling multiple old accounts, you've got one 401k with your new employer. Another benefit here is that the backdoor IRA strategies that a lot of people like to talk about, look into, they stay clean. By keeping the money in a 401k, instead of rolling it into an IRA, for example, you avoid what's called the pro rata rule. That means your Roth conversions stay efficient and less messy at tax time. The pro rata rule is kind of complicated to explain. It's not something I'm going to get into in this video, but it is something to consider. It's actually a situation that I encountered over the last 2 months with someone who had started backdoor Roth strategies, didn't have many old 401ks, but now they're starting to accumulate more retirement assets. And so while the backdoor Roth IRA is great because of the fact that you can then take out money tax-free, it's going to become less of an effective option. I'm going to do another video on this at some point. You'll also have creditor protection, just like I explained, if you leave your 401k at your old employer. And finally, loan access. Many 401ks allow you to borrow against your account. Now, I don't recommend tapping into your retirement account unless you absolutely have to. But this is a feature that is available, and it's not something you can do if you were to roll the old 401k into an IRA. Now, the downside, this goes back to what we were just talking about. If you leave your old 401k, you're going to have limited investment options for all those reasons that I just explained. Yes, you might have new fund options from a different fund family. It's more or less going to be that same menu with a mix of target date funds and specific stock and bond funds, which you can then mold your own allocation. Lastly, you have also the consideration of fees as well as potential for market lag. I think that these are less of a downside to even consider. If you do have any sort of market lag, it's because you're waiting for the funds to come from your old 401k to the new one. Again, it could be anywhere from 2, 3, 4 weeks. Over the long term, it's not going to make the biggest difference in the world, and it's more important to have everything unified in one bucket. Also, the fees, that's subjective. You just have to look at, because again, some 401k plans, while they're going to have the same menu, they'll have different fund managers. While most 401k plans will have that menu of different investment options, I have seen situations where when you check the expenses of the actual funds, they're on the more expensive side. And to me, more expensive is anything above 50 basis points. I would say that most funds that I see in a 401k, I don't know, for some reason, they tend to be less than 40 basis points, if not much less than that. So you just want to be kind of cognizant of that. Not that it's a deal breaker, but it's something to be aware of. So in summary, rolling an old 401k into your new employer's 401k, it can be a smart move. I like the consolidation aspect. It does potentially keep your backdoor Roth options more efficient. You definitely want to check out the investment lineup. Most likely, the investment options are going to be all relatively the same. Check the fees, though. See what the deal is there. Not that that should be the complete deciding factor, but like the other options, it really depends on the details of the plan and the bigger financial picture as well. The third option is to roll your old 401k into an IRA. This is probably the one that most people have heard about, and probably for good reason. If we look at things on the good side, there's really two significant benefits that I see here. The biggest benefit is the investment flexibility that you have. Unlike a 401k inside of an IRA, you can invest in just about anything. You can choose any ETF, any mutual fund, any stock that you want, any bond that you want, even alternative products like private credit or private equity. You can buy those particular investment products and put them inside of your rollover IRA. This is assuming if your custodian allows it, but you're not limited to a short list of investments like I've explained with inside of a 401k. And so the reason that this becomes beneficial to you is you can angle your investment philosophy and strategy to whatever you want to do. If you want to be way more defensive, you can. If you want to swing for the stars and buy single name stocks, you can. It's really up to you. The other big benefit is the simplification aspect of it. Again, less financial clutter. I kind of look at this as just having one bucket where you can put all of your old 401ks inside of it, creating less financial clutter, less logins to remember, less statements that you have to keep track of, less investment decisions that you have to be on top of and coordinate between different accounts. It makes things easier, like required minimum distributions and the calculations of that much easier. So all in all, I think those two things are really important in the long-term plan. Also, there is cost control. I mean, this is subjective. It can be controversial because of the fact that you can invest in whatever you want. Maybe you can control costs a little bit better. It sort of just depends. We talked about the planning flexibility. An IRA just gives you more freedom to line everything up within the bigger financial plan. Also, coordinating that with maybe a financial advisor that you work who can basically manage it for you, and also coordinate it and manage it with all of your other assets. So I think all of these things are all positive. In terms of the not so good, because it's not ruled by the ERISA guidelines, you're not going to have that creditor protection that I talked about before. Again, I find this to be less of something to be concerned about. The backdoor Roth strategy there could be an impact. So just like there is some good, there's always trade-offs. On the bad side, you're going to have less creditor protection when you do roll over an old 401k into an IRA. We've talked about that previously. We also just touched upon the impact of the backdoor Roth strategy. There's also loss of access to the age 55 rule. Again, less I think of a consideration in my opinion. And then finally, there's the effort factor. Just like I was explaining, when you're going to be rolling over a 401k, it's going to take a little bit of effort. It's going to take probably a 20-minute call. Usually what happens with me is when I'm helping a client do this, I'll get the custodian on the phone. So let's just say it's Fidelity or maybe it's Empower. I'll get them on the phone, conference in the client, and then walk through the process with the person on the other end. It generally takes 20 minutes or so. Could be a little bit longer, not much shorter than that. Yes, you're going to have to look out for a check that's going to come to you or however they're going to transfer the funds, but there's definitely going to be some effort involved. But I think in the grand scheme of things, like I was talking about before, a 20-minute phone call versus 2 to 2.5 hours and waiting and tracking 4 or 5 different checks that are coming in is a lot better because you're not going to want to do it later on, and it's going to get more complicated, and there's going to be some more hoops that you're going to have to jump through that you're not anticipating. So in summary, rolling an old 401k into a rollover IRA, it gives you more flexibility and control, bottom line. But it does come with some of those trade-offs that I mentioned before, but I think those are lesser of a consideration. But again, it's all situational. And the last option, which is universally advised against by financial experts, is to cash out your 401k. First, significant taxes. Any money that you're going to take out is going to be taxed at ordinary income. So whatever tax bracket you're at, that's the rate that you're going to pay. Second, you have the early withdrawal penalty. If you're under 59 and a half, you're going to be subject to that 10% early withdrawal penalty plus any taxes associated with it. And thirdly, it's the loss of future growth. I think that's kind of self-explanatory. So while technically cashing out it is an option, it's really the absolute last resort, and it's got to be for good reason. Most people are far better off doing any of the 3 options that I mentioned before. That's the bottom line. End of story. So in concluding, those are the 4 main options. Each has its pros and cons, just like anything else, and it becomes situational. If you're not sure what to do, speak with your financial advisor, someone that you trust. Yeah, you could go to a CPA. Don't know if I would totally recommend that. If you have any questions, you can always reach out to me. More than happy to help you. You can email me, call me. Unfortunately, you can't leave comments because of compliance purposes. I hope you liked this video and found it informative. Please give us a thumbs up. It really helps us figure out which content that we're producing and the information we're providing is resonating with you. Also subscribe as well, so that way you can stay updated on any future videos that come out. And with all that being said, we'll see you in the next one. If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.